Servus Leute und herzlich willkommen in einem brandneuen Video der Mission Money. Wir sind heute zurück mit einem sehr spannenden Gast aus den USA, ein Hochkaräter, und sicherlich einige von euch kennen ihn und wahrscheinlich haben einige von euch auch schon dieses Buch gelesen von Jeremy Siegel, Aktien für die Ewigkeit, im Original Stocks for the Long Run. Er ist Finanzprofessor an der Wharton School und jetzt bei der Mission Money. Welcome on the show, Jeremy Siegel.
I'm very happy to be here. Thanks for inviting me.
It's a pleasure, Mr. Siegel. Great to have you on the show. You recently said, enjoy the ride. Why do you think the market will go up further?
I think that we have had a totally unprecedented and probably excessive amount of monetary stimulation since the pandemic began. I think it's going to produce a lot more inflation than the Federal Reserve believes. I believe that after the episode is over a 3 or 4 year period, we may have 20% cumulative inflation, which is 4 or 5% per year for 4 years. And stocks are real assets, which means there are claims on capital and land and copyrights, intellectual property, trademarks, and real assets do well in inflationary periods. I think property will do well and real estate outside of commercial buildings, because I think Zoom and others have changed that, but everything else will do well. We all know we're having a housing boom in the US. I believe it's actually around the world to some extent. But we had more monetary stimulus than the rest of the year. We had an increase of the money supply last year that was greater than in the last 150 years. And that is absolutely extraordinary. And to me, that means more inflation.
You say more inflation, around about 4 or 5%. And when the economy will run hot, so the Fed could come under pressure and we could see higher rates. But this wouldn't be that nice for the stock market.
Well, I believe, there actually moderate inflation is good for the stock market.
Okay.
Firms are going to have a lot of ability for pricing to raise their prices. Costs will go up. Believe it or not, there's already a labor shortage, even with 6% unemployment, because we gave such strong unemployment benefits. A lot of people say, "Oh, I'm not going to work until I get a really good offer." So we see restaurants now starting up, as we were talking about, vaccine more advanced in the United States and most of Europe. So really things are opening up, and we see restaurants not having servers and cooks. They're advertising and they're raising their wages by 5-10% and more to try to get people to work. So, but people they have the money to pay for this cost. So costs go up, but there's money to pay for it, and that is what inflation is. So I think profits are going to be very good because pricing power is going to be very good. I actually think that the current estimate of what the profits are going to be for the S&P 500, which is now about 180, could be 190 or 200. I think it's good. We're going to be this year well above expectations.
Okay. Would you prefer value stocks over tech stocks at the moment?
I prefer value stocks, and I prefer value stocks for 3 reasons. One is because we are reopening the economy, which is going to generate, we will not have to rely as much on technology. Gyms will open, Peloton won't be as important. There will be more meetings, although Zoom is still important, but the growth will be much further down. So I think all the great things about technology that we learned during the pandemic is priced into these stocks at the present time. I think that there's many of them are selling at very high. Now, I don't mean Apple, the Apples and the Googles and Facebooks. They're still pretty reasonable. They're high, but they're reasonable. But I think that I think the airlines and everything else have come back. I think they're going to come back more. I think that people will seek dividend-paying stocks because I think inflation is very bad for fixed income holders. And if you want to buy inflation-protected bonds, they give you negative yields. I know even normal bonds in Germany give you negative yields. So in the U.S., we still have positive yields on regular bonds, but negative yields on inflation-protected bonds. So people will go for dividend-paying stocks. I believe that those are going to be the stocks that are going to do well. And we realize that higher interest rates used to be bad for value stocks or utilities, et cetera. I think now we realize that the growth stocks, because their cash flows are discounted so much into the future, that higher interest rates will discount those cash flows in the future. So I think that the rotation that we saw from September to January, February, we've had a little bit of a pause, little bit of bounce back in tech, but I believe it will reassert itself in the remaining 9 months of this year.
You said the stock market could surge about 40%, but isn't the comeback, the possible boom of the economy already priced in? So we need a surprise.
Yeah. Well, I think a lot of it is priced in, but I think I still think that we could have another 10 to 20% this year in anticipation of the inflation. And then I think longer term returns in the stock market are going to be lower than the historical average. You showed the book, long run in the US has been about 6.5% after inflation. In Europe, it's a little bit lower. Globally, I think over the last 100 years or 120 years, because several UK economists, Dimson, Staunton, and Marsh have looked into that, about 17, 18 stock markets since 1900. They get a global real return on stocks of about 5.5%. I think we're in for lower real returns. I think we are in for 4 to 5% real returns, but again, real. So it's gonna come over the inflation bump, and then looking forward, it's going to be more modest, but still way above fixed income. I think we are in a lower return environment around the world. Slower population growth, aging economies, more risk aversion. Older people are more risk averse, a bigger appetite for bonds, even at these bad rates. Bonds are seen as a short-term hedge against stock market volatility. So when we get a big drop in the stock market, we see treasury bonds go up by 1 or 2 points. So your portfolio has a short-term negative beta, as we say, cushion on there. So all this is driving the demand to treasuries. There's a long demand for treasuries. Despite that, I have been on record since last year as saying that the 40-year bull market in bonds in the United States and perhaps around the developed world is over. I don't know whether anyone today will see interest rates on long-term bonds as low as what we saw last year. I mean, I know for Europeans it isn't so low because you've gone negative, but for we Americans, 50 basis points, and we've had higher inflation and higher growth, so that's one reason why we do have a higher interest rate structure, is, I think, going to be the low. I don't think we're going to see that. So we have a lower interest rate, so you don't want to be in long-term bonds, because if the interest rate goes up to try to protect against inflation, you'll get capital losses. I think dividend-paying stocks, still a lot of very good dividend-paying stocks, 2%, 3%, 4%, and they are real assets. So those are good. I like REITs, real estate investment trusts, that are outside of commercial buildings, because I think that world has changed. And we see Manhattan commercial real estate down 25%. However, we have a tremendous boom in the housing market. We have boom in industrial real estate, warehouse REITs that house the computers and for the web services and the cloud. Everything outside of commercial real estate is doing very well on real asset side. I think commodities will do well. I think emerging markets might do very well because many of them are also linked to commodities. So this inflation, again, I'm not talking about hyperinflation. Nothing like what you had in the 20s in Germany. Nothing. I am not even talking about a double-digit inflation. Middle single level inflation. And I could be, it could be more early and less. It's very hard to apportion it. But when you have a 20%, 25% increase in the money supply above what you had before, I mean, I got my PhD at MIT, specialized in monetary theory and policy. And then my first 4 years, I went to the University of Chicago, assistant professor, young. I was a colleague of Professor Milton Friedman. I think you had someone on your show earlier on who actually talked about Friedman's money data and worrying also about the inflation that might be caused, because I was looking at some of your earlier. I don't know German, so I was trying to infer a little bit about it. I remember him telling me that central bank easing is important, but if it goes into just excess reserves and not lent out, it isn't as potent. If it gets into bank accounts, what we call, checking accounts, sight accounts, demand deposits, payroll accounts, the accounts that are in M2 or M3, as I know, the Germans have been calculating the M's for a long time, also under the Bundesbank, even before Euro. And once it gets into there, and again, it has gotten into those numbers at an unprecedented level. It's extremely potent. He said it's extremely potent. And I was just a very young assistant professor, but I studied all his work, and he has the data. Well, he won the Nobel Prize on the monetary history of the United States using this, developing this 150-year database. He was the first one to do it. And I believe that we will see the results of this excessive money creation in inflation in the United States.
Okay, inflation, okay, but we have also soaring real estate markets, especially in the USA. We have seen the stocks, Bitcoin, Dogecoin, everything at all-time high. So isn't this disturbing for you?
Yes, well, so this is very interesting. What is happening? Let me talk a little bit about this phenomenon. What is happening is that Bitcoin is the new gold. Younger people will go think about Bitcoin as they hedge against inflation, and it's only us older guys that think about gold. So gold did very well earlier last year, and then it's petered out and gone back down as Bitcoin has gone up. I have a lot of questions about Bitcoin. I think I'll tell you my questions about Bitcoin revolve around the fact that in the United States and other places in the world, we could have a much better payments mechanism, like they do in China. We don't even need, we hear a lot, and Europeans are working on what's called central bank currency, central bank digital currency. Honestly, we have the capability in our banking system today around the world with current technology to effect transfers at 10 basis points, 5 basis points between accounts. But we don't do it, especially in the United States, because MasterCharge and Visa and American Express, they monopolize charging merchants, 2.5%, 3%, and then on my credit card giving me back 2%, which is stupid. So they charge 3%, give me back 2%, and it's way too costly. So if the government stepped in, broke the monopoly, and said to merchants, you have an alternative, and you can actually transfer funds at a much lower rate, then I think Bitcoin loses a lot of its allure. So I heard an echo for a moment, but I think it's gone now. But I think that Bitcoin loses a lot of its allure if we get there. In summary, we have the potential in all our countries to have a payments mechanism that I think is far more efficient than Bitcoin. So what is the utility of Bitcoin if it isn't used for payments? In other words, if it's actually, it costs 50 basis points to make a Bitcoin transaction and costs 5 basis points to make it through the bank. So I worry about Bitcoin's long-term prospects. However, as long as there's no reform of the payment system, I think the potential for Bitcoin to go higher is certainly there.
But do you think it will be banned or could be banned like Ray Dalio recently said?
I don't think you want to ban it. I think all you need to do is, first of all, make people report it. Technically, when they buy or sell Bitcoin, under current regulations, if you made money, you have to report it to the IRS. Now, if you buy a Starbucks coffee for $2, and you're gonna have, in the U.S. technically you would get what's called a 1099 form, which is you report that as a capital gain or loss compared to your purchase price, and that's crazy. I mean, you couldn't operate like that. But technically, under current rules, if they just enforce current rules, it would be unwieldy to use Bitcoin. So how are you going to do that? Bitcoin, you buy Bitcoins at 50,000, and then you buy something else at 60. So you make a gain. You have to report that. You cash in to make a gain, and so the tax system makes Bitcoin very difficult. So you don't even need new laws to ban it. If you just enforce the current tax laws, it would make it very unwieldy to operate payments with Bitcoin.
Okay, let's come to the overall sentiment in your book here, Aktien für die Ewigkeit, Stocks for the Long Run. There's a story about the famous John Rusker, for example, who said everyone should be rich in 1929. A few months later, the stock market crashed badly and took very long to recover. So we have a similar sentiment today. Bitcoin, Dogecoin, stocks at all-time highs. So many newbies after the COVID crash. So many people want to be rich. What's your opinion?
Yes, well, I understand. First of all, in the U.S., the stock market is not as high as it was in 2000, okay, which was the peak of the internet mania that we saw. So, I mean, as I say, 22, 23 times earnings is a little bit rich. I think the new normal is about 20. Given the world, the liquidity, I will not go into all the reasons, but so we are a little bit on the higher side. Now, could it go down to 10 times earnings, which would be 50% or more? Of course, temporarily, and that would be the buying opportunity of a lifetime. But if I do not think the market is too high to keep on, if you keep on buying stocks on a regular basis, and that is the story at the beginning. What Raska recommended was just keep on buying. Sometimes the market will go up, sometimes down. As you accumulate over time, your wealth will grow at compound rates that will exceed any other asset that you have. And I do not believe that the valuation of the market today is too high for you to continue to buy it. I'm thinking of index. I'm thinking of broad-based. I'm not thinking of Dogecoin. I'm not thinking of Tesla only, just put everything in Tesla or batteries or whatever, You can always play with some of that money, but most of your money should be very broadly indexed to the market.
But is there a scenario for selling your stocks? So maybe when the market is really going up about 40% or higher?
You, as a younger person, you should always just continue to use some of your money every year to buy broad-based index around the world. And then use another small portion, if you really love the market, to do speculation. You might win, you might lose. I am not a speculator. So I'm not going to give advice to those people. My son does very well. He has some long-term holdings, but he plays a lot with the market, and he does very well, and that's good for him. I have never picked individual stocks. I've always thought of the macro picture and the whole market, and to continue to just put in the whole market, internationally diversify, use that as a base of wealth into the future. So
you just said the market could crash about 50%. So
everything's possible. I do think that next 3 years we will have a bear market, which is 20% or more decline. It could come earlier. The problem is it could go up 40% before it goes down 20%. So people tell me, well, I'll wait till the bear market comes. Well, no. That does not logically follow. Even if you know there's a bear market next 3 years, it does not logically follow stay out until the bear market hits. Because as I said, it could go up 40 before it goes down 20. So you will be buying at the bottom of the bear market at 20, and you'll still be buying 20% higher than today. Now, I'm just making up numbers. I'm not saying those are going to be, I'm just giving you a mathematical example.
So time in the market beats timing in the market, in your opinion?
Yes. Being in the, timing the market is an American expression, is a fool's errand. It's not, 98% of the people cannot do it. And in fact, it results in lower returns because you buy when everyone's excited and you sell when everyone's depressed, and that's exactly the reverse of what you should do in the market.
You just mentioned the bear market. Maybe a few more words for our viewers for the explanation.
Well, bear markets are defined as 20%. Major bear markets are usually defined as 40% declines. Now, we had a major bear market during the financial crisis. We had a regular bear market during the pandemic. We were down some 30% on S&P. But we were down over 40% on S&P and the broad-based market during the financial. We don't get major bear markets very often. 2 or 3 times a century do we get made. Now, the biggest bear market, of course, was 1929, 1932, where we went down, where the Dow Jones average went down 89%.
It's incredible.
From top to bottom.
So what is your concrete?
September to July, September 1929 to July of 1932, the Dow Jones was down 89%. We have never, ever approached that before or since.
And what is your concrete scenario for the next years?
I think this year is still going to be a very good year. Okay. Next year, we'll see whether the Fed starts moving against it. It'll be a little rockier. Mm-hmm. But we may overdo it this year as everyone tries to jump into the market because it's doing so well, and then you're going to get a correction. Mm-hmm. And that could be a bear market, could be 10 to 15%. It is almost impossible to time. I'm not going to try to time. Of course, everyone wants to know. But it is virtually impossible to tell you exactly when that might occur. And don't forget, it doesn't mean you should be out of the market now. It just means that if the market starts really moving up really strongly, 20, 25, 30% from now, then I would really begin to start lowering my stock allocation quite dramatically.
So it could become a bumpy road for investors when the Fed finally steps in.
A bumpy road up and down, especially if we get another 20% this year, 20 to 25%. Next year, I think, will be a relatively lower year, much lower year. You may get 0 to 5% on stocks in general. Some stocks do well, others don't.
Okay. Thank you so much, Mr. Siegel. As a conclusion, so you're a legend concerning stocks and the stock market. What would be your best advice for our viewers?
The best advice is to accumulate stocks internationally on a regular basis, indexed. So the broadest, cheapest indexes, I do not know all the instruments available for you in Germany. As you know, Vanguard has been the pioneer in the United States, and we have ETFs now, and I think there's ETFs available for you too. And cheap ways. And then, if you want to speculate on individual stocks, put 10, 20% aside for speculation, realizing you could lose it all. You could lose 80%. But that part that continues to be invested over time will be the what we call the bedrock of your wealth as you get older into your future.
Great. Thank you so much. It was a pleasure to have you on the show. Thank you.
Thank you very much for having me.
Und danke auch an euch Leute fürs Zuschauen. Jetzt bin ich sehr gespannt. Hier eine Legende aus den USA. Wenn ihr mehr davon sehen wollt, dann gebt doch einen Daumen nach oben und schreibt unbedingt mal in die Kommentare. Thank you so much. Danke euch fürs Zuschauen. Wir sind raus. Bis zum nächsten Mal. Ciao.